Welcome to the Time and Market Deep Dive. You know, usually when we talk about artificial intelligence, there's this expectation of it being entirely digital.
Right, like it's just magic.
Exactly. Like
Yeah.
magic. You type a prompt into a chat box, the data floats up into the cloud, and the answer just, materializes on your screen. It
hmm
feels completely weightless.
Yeah, we do love to imagine algorithms as these invisible forces, right? Like they're completely untethered from the physical world.
But then you step into the world of semiconductor manufacturing and supply chains, and suddenly that weightless cloud comes crashing down to Earth,
Oh, absolutely. Hard impact.
right in the form of a massive hardware bottleneck. So today, we are doing a deep dive into the massive 2025 and 2026 memory chip supercycle.
It is a wild market right now.
It really is. And before we get into the data from the stacks of reports we have today, so we're looking at Trading Key, Rebound Electronics, CRN Asia, and Motley Fool. Just a quick reminder, we are here to analyze the mechanics of this market for your entertainment. We are not here to manage your portfolio.
Definitely not.
Yeah, you should always seek professional financial advice before making any investment decisions. Because honestly, the data we're looking at today is just wild.
It really is unprecedented.
So our mission today is to extract the vital insights to help you understand exactly why memory chip prices are exploding right now. And we'll analyze the strategies behind specific investment vehicles, like the newly launched ticker DRAM, along with some broader semiconductor ETFs.
That's like a solid plan.
Okay, let's unpack this. I see you calmly organizing your notes over there with that great cityscape behind you, looking very ready to synthesize all this tech and finance chaos into a big picture perspective. So, where's the best place to start?
Well, the best place to start is really the physical reality. I mean, before we even look at a single stock ticker or, an ETF strategy, we have to understand the physical constraints driving this whole market frenzy.
Okay, the physical hardware side.
Right, because the root cause of everything we're seeing is the explosion of AI data centers. And that has created this absolutely insatiable demand for a very specific type of hardware, which is high bandwidth memory or HBM.
Right, HBM. I hear that term thrown around a lot in these reports. But how does that physically differ from, like, the standard memory sticks I might buy to upgrade my home computer?
It's a completely different beast. Modern AI accelerators like NVIDIA's cutting-edge GPUs, they require an entirely different architecture to function.
Okay.
Because training a large language model requires moving petabytes of data back and forth incredibly quickly. Standard memory simply isn't fast enough. It basically creates a traffic jam.
So the data just gets stuck waiting in line.
Exactly. So high bandwidth memory is actually a stack of memory chips layered on top of each other, sitting right next to the processor itself. It allows for this massive superhighway of data.
Oh, wow. So it's 3D.
Yeah, 3D stacked chips, but manufacturing them is intensely complex.
So because these massive AI data centers are willing to pay huge premiums for this specialized HBM, what are the manufacturers doing with their factories?
Well, they're aggressively reallocating their wafer capacity.
Meaning what exactly?
Meaning they're taking the raw silicon wafers that would normally be used to make standard commodity DRAM, the memory used in regular PCs, laptops, consumer electronics,
Right.
and they are physically shifting those factory lines to make HBM instead.
Okay, I think I get it. Think about it like a wildly popular neighborhood pizza shop, right?
Okay, I like pizza.
For years, they've sold individual slices to regular walk-in customers. It's steady, reliable business. But suddenly they realize that catering massive, multi-million-dollar corporate parties, which are AI data centers in this scenario, is incredibly lucrative.
Right, way higher margins.
Exactly. The corporate clients want specialized, gourmet, multi-layered pizzas. So the shop just stops selling individual slices to the walk-ins. They put all their dough, all their ingredients, and all their ovens toward the corporate orders.
Yeah.
That's exactly what's happening.
So what happens to the walk-in customer? The price of a single slice of standard pizza absolutely skyrockets because there are hardly any left in the shop.
That's a great analogy. The commodity memory market is starving right now because all the physical dough is going to the AI hyperscalers.
And the numbers back this up in a terrifying way for anyone trying to build a PC right now. Like, looking at the industry reports, there's this shocking stat. A standard 16 gigabit DDR5 chip, which is just a basic building block for computer memory, spiked from $6.84 in September of 2025 to $27.20 by December of 2025.
Yeah, that's just insane.
That is roughly a 300% increase in just 3 months. PC builders are citing a 500% surge in overall RAM costs. It has completely upended the consumer electronics market.
What's fascinating here is the cycle lag.
Mm.
You might look at those prices, see a 300% markup, and assume these manufacturers would just spin up a new factory tomorrow and print money.
Right, why wouldn't they? But the timeline to build a new semiconductor fabrication plant, or a fab, is 3 to 5 years.
Wait, really? 3 to 5 years? Why does it take so long? We build skyscrapers faster than that.
A fab is arguably the most complex manufacturing environment on Earth. I mean, you have to construct highly specialized clean rooms that are thousands of times cleaner than a hospital operating room.
Wow.
Just a single speck of dust can ruin an entire batch of chips. And then you have to install the manufacturing equipment, specifically extreme ultraviolet lithography machines.
The EUV machines, I see those mentioned all the time in the tech news. Could you break down what those actually do?
Sure. Think of them as microscopic, highly precise stencils printing at the atomic level. They use a wavelength of light that doesn't even naturally occur on Earth to carve these microscopic pathways onto the silicon wafers.
Light that doesn't occur naturally on Earth. That sounds like science fiction.
It really does. And these machines cost hundreds of millions of dollars each. They take months just to calibrate once they're delivered. And even after everything is installed, you have to slowly ramp up your yields.
And yields in this context refers to what exactly?
Yield is the percentage of functional chips you get from a single silicon wafer. When you start a new manufacturing line, especially for something as complex as HBM, your yield might be terrible.
Like how terrible?
Yeah, maybe only 30% of the chips on the wafer actually work because of microscopic defects in the new process.
Oh, wow. So you're throwing away 70% of your product.
Exactly. It takes years of tweaking the recipe to get that yield up to a profitable 90%. So this supply crunch, it just cannot be fixed overnight. The supply of memory is essentially capped in the near term, while the demand from AI is growing exponentially.
So because it costs hundreds of millions of dollars just to buy one of those EUV lithography machines, the barrier to entry is basically a massive brick wall.
A very expensive brick
Yeah.
wall. Yeah.
That's why we aren't seeing 50 new startups jumping in to solve this supply crunch. In fact, looking at the CRN Asia report, we're really only looking at 3 companies.
Right. The global DRAM market is effectively an oligopoly. Roughly 70% of the entire global market is controlled by just 3 giants, Samsung, SK Hynix, and Micron.
Just 3 companies holding the physical keys to the AI kingdom. And the market is rewarding them handsomely. I mean, by May of 2026, the AI rally pushed all 3 of these companies past the $1 trillion market cap threshold. South Korea alone now has $2 trillion companies in Samsung and SK Hynix.
It's a historic consolidation of wealth and market power. But here is the critical strategic element driving the current dynamic. Despite this newly minted trillion-dollar wealth, and despite the soaring prices of basic memory, these 3 companies are deliberately limiting the expansion of commodity DRAM production.
Okay, I am genuinely confused by that. If I'm sitting in the boardroom at Micron or Samsung, and people are screaming to pay 300% more for a commodity DDR5 chip, why wouldn't I take my trillion-dollar market cap, build more lines, and capture that revenue? Leaving that much money on the table seems completely counterintuitive.
You have to look at the historical psychology of these boardrooms. The memory market is brutally cyclical.
Okay.
Over the last few decades, these manufacturers have repeatedly fallen into the exact same trap. They overbuild during a massive boom, demand eventually normalizes, and they're left with massive oversupply.
Which causes prices to crash to the floor.
Precisely. Right now, these executives are looking at the AI frenzy and asking a terrifying question: what if this is an AI bubble?
So they're worried about getting caught holding the bag.
Exactly. They are wondering what happens if they commit hundreds of billions of dollars to new commodity DRAM fabs today, and by the time they finally open in 2028, the AI hype has cooled, hyperscalers stop buying, and suddenly there's a massive glut of wafers.
Here's where it gets really interesting. By being conservative to protect themselves from a future crash, they are engineering an even worse scarcity right now.
Right. If we connect this to the bigger picture, their conservative strategy is precisely what's driving their valuations to unprecedented heights. The market knows they have absolute pricing power, and they aren't going to dilute it by flooding the market with supply.
And it isn't just corporate strategy holding back that supply, right? There are hidden physical choke points in the supply chain that you wouldn't normally associate with tech hardware.
Oh yeah, the raw materials.
Right. The Rebound Electronics Q1 Market Insights report highlights escalating geopolitical tensions in the Middle East. And at first glance, you might wonder, what does the Middle East have to do with Taiwanese or South Korean chip fabs? The answer is helium.
The reliance on industrial gases is a fascinating vulnerability in the tech supply chain. It really is.
So the Gulf region is a major supplier of helium. Now, normally we think of helium for, party balloons, but why is it so critical for semiconductor manufacturing? Why can't they just use something else?
Well, helium is totally unique, and it cannot be artificially manufactured. It's mined from deep underground, often as a byproduct of natural gas extraction.
Okay.
And in chip manufacturing, things get incredibly hot during plasma etching. You need a way to cool the silicon wafers rapidly to prevent them from literally melting.
Wow, okay.
Helium is totally inert, meaning it won't chemically react with the sensitive silicon, and it has the lowest boiling point of any element in the universe. It is the only substance capable of achieving the extreme cryogenic temperatures needed in a fab without freezing solid itself.
You literally cannot make these advanced chips without it.
You really can't.
So you've got corporate caution restricting supply on one side and geopolitical risk threatening the raw materials on the other. It's a perfect storm for a supply squeeze.
A very lucrative storm for a few companies.
Exactly. With Samsung, SK Hynix, and Micron practically printing money in the middle of this, Wall Street is obviously packaging this trend for everyday investors. Yeah. Enter the new heavyweight on the block, the Round Hill Memory ETF, trading under the ticker DRAM.
This specific ETF is a fascinating case study in thematic investing and market timing, really.
Launched on April 2, 2026, the DRAM ETF has been nothing short of a historic home run. According to the Motley Fool and Round Hill's own data, the price nearly doubled, up over 90% in just a matter of weeks.
Which is incredible for an ETF.
Yeah, its assets under management, or AUM, blew past $10 billion, with some sources putting it at $12.8 billion. It's marketing itself as the world's first pure-play memory ETF.
And that pure-play distinction is the main selling point.
Right.
If you buy a traditional semiconductor ETF, you're getting a massive basket of companies. You're buying companies that design logic chips, companies that make networking equipment, companies that manufacture foundry tools.
So it's watered down.
Exactly. Your actual exposure to the memory bottleneck gets heavily diluted. The DRAM ETF promises to strip all that away and give you direct, highly concentrated exposure to this specific hardware shortage.
But let's look under the hood for a second. The sources show it holds only 9 to 15 stocks, and its top 3 holdings, Micron, SK Hynix, and Samsung, account for roughly 74% of the entire portfolio.
That is extremely top-heavy.
Right. They call it a diversified ETF. But looking at those holdings, how does that math work for risk? If 3 companies make up 3/4 of the fund, it feels less like a safe basket of stocks and more like walking into a casino and putting all your chips on 3 numbers at the roulette table.
The skepticism is entirely warranted. Attaching the label ETF gives a product this aura of broad diversification, but the concentration risk here is severe.
Yeah, it has to be.
You're essentially making a highly concentrated bet on the management teams of those 3 specific companies and their ability to navigate the specific AI cycle. If one of those 3 companies stumbles, say, if Samsung continues to struggle with their HBM yields, or if SK Hynix faces a geopolitical export restriction, this ETF will feel that impact massively.
Because it's so concentrated.
Exactly. It does not have the broad padding of a 50-stock index to absorb the shock.
And as I read through the structure of this fund, it gets even more complex. To maintain regulatory compliance with that extreme level of concentration, they're utilizing something called total return swaps. Can you explain what that mechanism actually is?
Yeah.
Because it sounds like you don't even own the underlying stocks.
Yeah, a total return swap is a complex derivative contract. Instead of the ETF buying shares of Samsung directly on the open market, the ETF enters into a contract with a major investment bank.
Okay.
The bank agrees to pay the ETF the total return of Samsung stock, any price appreciation, and dividends. In exchange, the ETF pays the bank a set rate.
So it's essentially a side bet. The ETF is placing a bet with a bookie about how the stock will perform, rather than just buying the horse.
Yeah, that captures the dynamic really well.
Yeah.
And the danger there is counterparty risk.
Uh-huh.
If the investment bank, the bookie in your analogy, faces a severe liquidity crisis or goes bankrupt, the ETF could lose its investment even if the underlying stock of Samsung is doing well.
That's a huge risk.
Right.
But because this initial ETF has been so wildly successful in raising capital, Wall Street is already doing what Wall Street does best, pushing the envelope.
Oh, of course they are.
As the Motley Fool highlighted, there are already filings to launch a 2x leveraged version of the DRAM ETF. a leveraged version of a 15-stock portfolio where 3 stocks make up 74% and relies on total return swaps.
I really need to warn you about the mechanics of leveraged ETFs here, specifically a mathematical trap called volatility decay.
Okay, let's hear it.
Leveraged ETFs reset their exposure daily. They are designed to give you twice the return of the index on a single day. But over multiple days, weeks, or months, the math inherently turns against you in a volatile market.
Because memory stocks are nothing if not volatile.
Precisely. If you have a highly concentrated volatile sector, the daily compounding of a leveraged fund will erode your capital, even if the underlying stocks eventually go up over a long period. It's designed as a day trading instrument, not a buy and hold investment.
So if the DRAM ETF represents a highly aggressive, concentrated bet and a leverage version is basically playing with fire, how should you compare this to the broader semiconductor ETF landscape when designing your own investment strategy? Like, let's look at the alternatives.
This raises an important question about matching the financial tool to your specific thesis and, really, your risk tolerance.
Right, so we have the DRAM ETF, which we just discussed. That is for investors who are strongly bullish specifically on the AI memory bottleneck and who are totally comfortable with high concentration and the liquidity risks that come with the newer, smaller fund compared to the legacy giant.
Exactly. Now, moving outward, you have SMH, the VanEck Semiconductor ETF. This is a massive, established fund, but it's heavily concentrated in the megacaps of the broader chip world.
Right.
We're talking massive weightings in NVIDIA, TSMC, and Broadcom.
So SMH lets its winners run without heavily capping their size.
Right.
But, as TradingKey points out, because NVIDIA and TSMC take up so much of the room in that ETF, your actual exposure to the memory supercycle is heavily diluted. You own the AI brain, but not necessarily the memory it relies on.
That's exactly right. Now, contrast SMH with SOXX, the iShares Semiconductor ETF. SOXX uses a capped weighting system.
Yep.
No single stock can be over an 8 to 10% weight. When they rebalance the fund, they actively trim the winners and reallocate capital to the laggards.
I like to think of SOXX as cap weighting, like managing a professional sports team, where league rules state no single superstar can take up more than 8% of the salary cap.
That's a good way to look at it.
It forces the manager to build a deep, balanced bench rather than just relying entirely on one expensive player. It prevents NVIDIA or Micron from taking over the whole fund. It seems best for broader, safer exposure to the entire chip cycle design, equipment, foundry, memory, literally everything.
SOXX is really for the investor who believes in the semiconductor industry as a whole, but wants to actively manage single stock risk through enforced diversification. And finally, we have SOXL.
The 3X daily leverage tool.
Yes. As the GotTrade analysis explicitly states, SOXL is a trader's tool, not a buy and hold investment.
Right.
Let's walk through the math of volatility decay from your perspective as an investor, because seeing how your own money moves makes this much clearer.
Okay, let's do it.
Imagine you put $100 of your own money into a theoretical underlying index and another $100 into a 3x leveraged fund tracking that exact same index.
Okay, my money is on the table.
On day one, the index goes up 10%. Your $100 in the regular index is now worth $110.
Sounds good.
But the 3x leveraged fund goes up 30%, so your $100 there grows to $130. You're feeling fantastic.
I'm feeling like a genius. The leverage is working beautifully.
But on day two, the market gets choppy. The underlying index drops roughly 9.1%. That 9.1% drop takes the index from $110 exactly back to $100.
Okay.
Over the 2 days, the index is perfectly flat. It went up, it came down, it's right where it started.
So my regular index investment is back to $100. No harm, no foul.
Right. But look at your leveraged account. The index dropped 9.1%, which means the 3x leveraged fund has to drop 3 times that amount, which is 27.3%.
Oh, no.
Yeah. If you subtract 27.3% from your $130 balance, your account falls to roughly $94.50.
Wow. The underlying index went nowhere. Like it started at 100 and ended at 100. But because of the daily reset, I lost over 5% of my actual money just to the mathematical mechanics of the fund.
That is volatility decay in action. Compounding works violently against you in a choppy market. That is exactly why holding these leveraged instruments for long periods in a volatile sector like memory is incredibly dangerous.
That is a stark warning. And it's a perfect example of why digging into the mechanical engine of these vehicles is so important before you ever hit the buy button. We have covered a massive amount of ground today.
We really have.
We explored the gritty, physical reality of the AI-driven HBM shortage, how the complexity of building 3D memory chips and 3-year fab construction times are effectively starving the consumer market of silicon wafers. We looked at the trillion-dollar rise of the oligopoly, Samsung, SK Hynix, and Micron, and how their strategic fear of a future bust is driving today's prices even higher. We even explored the fascinating geopolitical choke point of helium gas and its cryogenic properties. And finally, we broke down the structural differences between placing a highly concentrated, swap-based bet with the DRAM ETF versus utilizing broader salary cap style strategies like SOXX and avoiding the mathematical trap of leverage decay with tools like SOXL.
It is an incredibly complex ecosystem. I mean, the ripples from these boardroom decisions are being felt everywhere, from the price of a gaming PC to the launch of multi-billion-dollar financial derivatives.
So what does this all mean? Well, it means that navigating a technological supercycle requires matching the right financial instrument to your specific risk tolerance, rather than just blindly chasing the hype.
Absolutely.
The headlines will scream about 90% returns and trillion-dollar valuations, but as we've seen, the underlying physical and financial mechanics dictate the reality of the market. And as a final reminder, this deep dive is strictly for entertainment purposes, and you should absolutely consult a professional financial advisor before making any moves.
I want to leave you with a final, lingering paradigm shift to ponder.
Okay, let's hear it.
Everything we have discussed today, the severe hardware shortages, the physical price spikes, the multi-billion-dollar ETF inflows, it is entirely predicated on the current state of AI software. We know that the current supercycle is driven by large language models demanding massive physical memory footprints.
The massive superhighways needed to move petabytes of data back and forth instantly.
Exactly. But what happens if the software evolves faster than the hardware?
Oh.
What happens if software engineers eventually invent highly optimized, deeply memory-efficient AI architectures? Imagine a breakthrough algorithmic model that can achieve the exact same reasoning results with a tenth of the memory footprint.
That would change everything.
Right. If software suddenly requires drastically less physical memory, right around the time these massive $100 billion new fabrication plants finally come online in 2027, 2028, could the technological cure for the shortage actually trigger the next massive market crash?
Wow. It is the ultimate irony. The very software innovation that AI promises could be the exact thing that pulls the rug out from under the physical hardware market that built it. We started today by talking about the tension between the invisible AI cloud and the incredibly heavy physical constraints of silicon. But it turns out the invisible cloud might just have the last laugh. Until next time, keep digging beneath the surface.